Hey everyone, welcome to The Explainer. I'm absolutely thrilled you're tuning in today because, well, we're on a mission. We are going to decode market manipulation by doing something incredibly powerful, reading the tape. We're going to look at exactly how price action moves, what it leaves behind, and how you can spot the hidden footprints of the market's biggest operators. Honestly, if you've ever felt like the market is out to get you, you are exactly in the right place.
Let's kick things off with a feeling I bet we all know a little too well. You're watching a chart, right? You see this perfect setup forming. The price breaks a key level, the momentum looks completely unstoppable, and you confidently hit buy or sell on that breakout. And then, what happens? Literally the very second you enter, the market violently reverses, it sweeps right through your stop loss, kicks you out of the trade, and then, just to add insult to injury, it happily continues in your original direction. It's a painful, frustrating, and incredibly relatable experience. But why does it happen?
Let's get into Section 1, the big player trap.
Okay, let's dive into this. To understand these sudden, brutal reversals, we have to look past the basic patterns and really dig into the psychology operating behind the scenes. First up, we have to introduce the true Goliaths of the market, the big players. These are the institutional operators, and their defining characteristic is that they trade in massive, massive quantities. When they enter the market, their sheer volume causes very rapid, aggressive movements. But here's the catch. To buy or sell that much volume without completely breaking the market, they need a counterparty. They need liquidity. And to find that liquidity, they intentionally hunt the stop losses of everyday retail traders. They weaponize their size. Now, they don't hunt your stops because it's personal. They do it because they're hungry, and your stop loss is on the menu.
So you might be wondering, how do these big players know exactly where to find our stop losses? Well, it all comes down to market structure. Market structure is essentially the simplest form of price movement. It's your basic support and resistance levels, your swing highs and your swing lows. The big players know these charts just as well as we do. In fact, they rely entirely on the fact that retail traders so predictably place their entry orders right at the breakouts and their stop losses right below basic structural levels. Because our behavior is so predictable, they know exactly where to set up the hunt.
Section 2. Visualizing the trap.
Let's do a quick autopsy on a failed trade setup to see exactly how this liquidity hunt unfolds in real time. What we have here is a textbook fake breakdown. The price drops below a key structural support line. As soon as this breakdown happens, retail traders jump in aggressively to sell, totally convinced the market is about to tank. At the same time, the sellers who are already in the market from higher up are looking to take profit, and they desperately need fresh buyers to take their positions. The big players know all of this. As the new retail traders aggressively enter this breakdown, where do they put their safety net? Yep, they place their stop losses just above that breakdown candle. The trap is now perfectly set.
And here is the immediate aftermath. Just as those new traders enter without waiting for any real confirmation, the trap snaps shut. The big players step in and buy up all that aggressive selling, triggering a really sharp reversal. Notice the exact moment the market flips with back-to-back green candles, sweeping rapidly upward to intentionally hit that cluster of stop losses resting just above the entry. Those new retail traders are instantly trapped and stopped out. Contrast that panic with the smart money who were patiently waiting. The impulsive traders' losses literally just became the fuel, the liquidity, for the big players to take full control.
Section 3. Anatomy of a candlestick.
Okay, so how do we protect ourselves? How do we see this coming before it happens? To do that, we need to slow things down significantly. We're going to zoom all the way in and examine the very building blocks of the chart itself. A candlestick has two main parts. First, you've got the solid colored section, the real body. The body tells us where the price opened and where it closed. It shows us where the market actually agreed to hold value. But then we have the shadows, commonly called wicks, extending above and below the body. These wicks indicate the extreme price range during that exact same period. They show us where the price traveled, but ultimately got rejected. This critical distinction between the agreed value of the body and the rejected value of the wick is everything when it comes to reading market manipulation.
Moving on to Section 4, spotting the liquidity grab.
With that anatomical breakdown fresh in our minds, we can really start connecting the dots. We have to draw a stark contrast here. When a market is experiencing standard, healthy momentum, you're going to see thick, solid real bodies. A big green or a big red body shows continuous directional strength. It means buyers or sellers are firmly in control from open to close. But a liquidity sweep, it behaves completely differently. A liquidity sweep is characterized by long wicks. A long wick visually represents a sudden, volatile push into a price zone,
triggering all those hidden stop losses, followed by a massive aggressive rejection that pushes the price all the way back. The price couldn't hold there, it just spiked in to grab the liquidity and ran.
Section 5, wicks, the trap fingerprints.
So the absolutely crucial point is this. Long wicks at key structural levels are the ultimate fingerprint of a trap. Whenever you see a massive wick piercing through a support or resistance line, you are literally looking at the exact scene of the crime where retail stop losses were just hunted. Notice the defining feature in both the shooting star pattern and the evening star pattern? It's that long upper wick. The market pushed up, inviting retail buyers to jump in on what looked like a sure continuation of the trend. But the big players immediately overwhelmed them with selling pressure, completely unable to keep the prices up. That long wick is the visual proof that the buyers were trapped, their momentum was rejected, and a bearish reversal is likely underway.
And finally, Section 6, trading with smart money.
All right, so we know we're being hunted. We know exactly what the trap looks like. Now let's shift gears and empower ourselves. How do we stop being the prey and actually start trading alongside the smart money? The sources outline a very clear step-by-step approach to avoid the trap. Step 1. Spot the breakout, but do not aggressively enter it. Let the novice traders jump in and take that risk. Step 2. Wait for the retest. Let the market come back to that breakout level. And Step 3. Look for the confirmation candle. This is where you hunt for our trap fingerprint. If the market retests the level and forms a candle with a long wick rejecting that zone, you now have visual proof that the liquidity sweep is over and the big players are defending the level. Waiting for this specific confirmation allows you to enter safely, intelligently, and with a very tight stop loss.
It honestly all comes down to patience and reading the story the candles are telling you. The big players rely heavily on your impatience. They rely on you taking that direct breakdown without waiting for confirmation. But now you know how to spot the trap. You know that those long wicks are the telltale sign of a liquidity sweep. So I'm going to leave you with this question to carry into your next trading session. Next time you see a perfect breakout forming on the charts, are you going to be the hunter waiting for confirmation, or are you going to be the liquidity? Thanks so much for joining me on this explainer, and happy analyzing.